Aloha, this is Brother Kimball, and this is my lecture for our Friday class that I will not be able to attend. We're moving into phase 1-7. As you can see, we're wrapping up phase 1. This is the second to last step of phase 1. In this case, we're going to gather information to assess fraud risk. This is the risk that due to fraud, there are misstatements in the financial statements. So this factor, this fraud risk that we've assessed, we're going to assess it as a high risk, a medium risk, or a low risk. And that risk will influence how much tolerable misstatement we can allocate out to the accounts. The lower the fraud risk, the higher the multiplier that we multiply against materiality to arrive at the tolerable misstatement to be allocated. The higher the fraud risk, the lower the multiplier. So if you have a high fraud risk, we'll have a multiplier of 1. We take materiality times 1, and that amount is what will get allocated out to the various accounts for testing, called tolerable misstatement. As you can see, we are sitting down here at phase 1-7. So the auditor has a responsibility to plan and perform the audit to obtain reasonable assurance that material misstatements, whether due to error or fraud, are detected. So it doesn't matter whether it was error-induced or fraud-induced, we have the same responsibility for detecting material misstatements in the financial statements. By the way, when I was an auditor, this didn't used to be the case. This is actually a new standard, relatively new now, where in the past we said, hey, well, if it was caused by fraud, that's not our fault. We didn't have to discover that. But that's not the case anymore. Whether it's due to error or fraud, we have the duty to plan the audit and perform it to obtain reasonable assurance whether material misstatements exist or not, due to error or fraud. So there's two types of frauds. There's misappropriation of assets. So as you can tell here, he's bundling up the cash and he's running away with it. So this is cash that belonged to the company and he effectively stole it. You can misappropriate pens, you can misappropriate pencils, you can misappropriate hard drives, you can misappropriate vehicles, buildings, whatever, somehow where you effectively take the company's resources and use them for your own purposes. That is a type of fraud, and we call that misappropriation of assets. The other type of fraud is fraudulent financial reporting. This is where they manipulate the numbers that are reported in the financial statements to make them look better or worse than they should. A lot of people don't think about the financial statements looking worse. But let's say you're trying to sell, let's say you are a minor shareholder that works for the company, and you are wanting to buy out the company, like a management buyout. You could theoretically cause the financial statements to look worse than they are so that you could buy the company at a lower price than what it really should sell at. Naturally, the opposite is also true. Fraudulent financial reporting may be a situation where you overstate net income to achieve certain bonuses that you may deserve, or increase the stock price so you could sell it. That would be fraudulent financial reporting. So there's no real legitimate economic transaction, but you manipulate the numbers to make them look better or worse than they should. So due to the risk of fraud, auditors need to perform their audits with professional skepticism. This doesn't mean that you think everybody's lying, right? You don't come and say, whatever they say, I know you're lying. Professional skepticism effectively says that you consider what things say with the possibility that it may not be true and that you may need to perform additional procedures to justify that. So rather than coming out and telling me you think you're lying, you can say, hey, could we obtain some, could we do some testing of that, those transactions, and you effectively trust but verify kind of idea. Okay. So what sources can help the auditor assess fraud risk? One of the things that you'll do for class is you'll get in a group of 3 or 4 students, let's say, and you'll have what's called a brainstorming session where all of you, based on your understanding of the business from the past or your understanding of the people who work for the business in the community, things like that, you're going to sit down and you're going to brainstorm and you're going to discuss the things that you think identify fraud risk factors. Factors that increase the risk of fraud, whether that be misappropriation of assets or fraudulent financial reporting. Another source of information can be client management, where you ask questions of client management. You're going to go and have lunch with them. You'll also sit down and have meetings with them, and you'll ask various questions that may help you identify those fraud risk factors. There's also the fraud triangle. If you recall what the fraud risk triangle is if there's pressure, so anything that indicates additional pressure on the people involved, if there's opportunity, meaning like weak internal controls where someone could actually pull off the fraud, and rationalization where, based on what you understand of their ethical their ethical mindset, can they rationalize their behavior? So you're going to get together and you're going to discuss these things and identify various fraud risk factors, which will then help you come to an overall fraud risk assessment of high, medium, or low, which will then influence the multiplier against your materiality that computes your planning, your tolerable misstatement. The larger the tolerable misstatement, the less testing you'll have to do. The smaller the tolerable misstatement, the more testing you'll have to do. So high fraud risk results in a low tolerable misstatement. Low fraud risk results in a high tolerable misstatement. So other audit team members can be very helpful. For example, I'm sorry this is already here. It says an ability to think like a critic helps. So in other words, can you think how they might pull off these frauds, and that might help identify things. So where are the financials susceptible? That's great discussion. You look at the financials and you say, hey, where might some accounts exist that people might use to commit fraudulent financial reporting? How could management achieve fraudulent financial reporting? How could they pull it off? How might someone misappropriate the entity's assets? So, for example, if you see they have a big warehouse and there's no one at the entrance or the exit, that would be checking to see if people are walking away with big screen TVs. You could say, well, I think there's a fraud risk factor that inventory gets misappropriated. What should the audit team do to address the susceptibility of material misstatement due to fraud? So all these are what you would discuss in your brainstorming session about fraud risk factors. Next, you inquire of management. SAS 99, Statement of Auditing Standards, SAS 99. This is new since I started auditing. Requires auditors to actually ask management, do they know of any fraud or suspected fraud? How do they assess fraud risk? What's the nature of the risk? Have frauds been reported to governance? What internal controls mitigate the risk? Studies have shown that when people are aware of fraud, they won't tell the auditor unless the auditor asks. But if the auditor does ask, they often will tell. So for example, let's say I worked at a company and I knew that the controller was using the company credit card for personal purchases of TVs and other consumables. I might know about that, and I may even have a meeting with the auditor, but the auditor doesn't ask me specifically, do you know of any fraud that's occurring, or do you know of any misappropriation of assets? Do you know of any theft that's going on in the company? I might not say. So just be aware that we're told that we need to ask the question, because if you do ask, people tend to be honest and tell you. But they don't feel the need to tell you unless you ask, and therefore they don't feel dishonest by not telling you. Fraud risk factors. You may have seen this in Accounting 201. If people feel pressure, so if you see someone living beyond their means, for example, or if you see someone who's under a lot of stress to meet certain sales targets, or those types of things, they may feel that pressure. If they can rationalize, where they can justify their behavior committing the fraud, for example, I work so hard, I deserve better, that kind of stuff. And perceived opportunity, they have the recording, authorization, and custody related to a given transaction. That would be an opportunity. Or there's no locks on the door. That's an opportunity to steal or misappropriate assets. So you should be aware of these fraud risk factors. I'm going to put the remaining slides on another video.